Financial value is entirely a matter of the present value of the future returns, and this means an estimation of the future returns, the future cash flows in analysis, is vital to understanding investment value today. And so this presentation is going to look at the questions related to understanding how to forecast the critical financial parameters necessary for property investment. The objectives of the presentation will be, first of all, to look at the matter of how the future behaves, what influences we need to be sensitive to, and especially the question of how the future unfolds, whether it's linear or some sort of fluctuation. We're going to take that as the springboard to look at the matter of property cycles and couch them within the more general topic of business cycles. Then we will review the various methods which are commonly being employed for forecasting in the financial area. And from that, we will look at their effectiveness, but also cautions about their shortcomings. Finally, we want to move into an introduction of chaos mathematics. Chaos mathematics is a misunderstood but very promising area that is used both in the physical and social sciences. And while chaos connotes confusion and craziness, we'll find that chaos is actually a very precise form of mathematics that nevertheless is capable of providing almost endless variety. Ultimately, all property investment opportunities rest on the behaviour of the future society. The future demand for space influences the demand for development and gives it its value. So the developer must be able to understand and infer the demand for space that will be happening at the time when his development will come online, say 2 to 5 years into the future, depending on the scale of the development. Likewise, the developer will be selling either to an owner-occupier who, for whatever reason, sees value in using the property, or to an investor. The property investor is motivated by their expectation of the potential rental return, and this again is spun out into the future as an expectation of the long-term rental prospects for the property that's being considered. An important part of the long-term rental potential is the capital gain, and so the property investor needs to have an understanding of where the long-term values are going to move, and this in turn is dependent on the condition of society at some point in the future. When we look at these things, we see that the future property prices depend on the future property rents, but the future property rents themselves depend on the future economic and social conditions of the entire community. And for this reason, a property economist needs to be sensitive to the complexities of society, which ultimately impact back on the health of the community's economy and their willingness to pay rents for property. This means that analysis requires precise prediction of future social and economic conditions, as well as the more likely financial variables. Economic theory itself has something to say about the future. Conventional economic theory is premised on the basis of equilibrium. That is, that the expectation is that under the conditions of perfect market competition, prices and economic activity will all settle down to long-term constant trends. So prices will settle down to known constant prices, and the overall parameters of production and consumption will tend likewise to settle into predictable constant levels. The economist's view that the economic world is always settling towards equilibrium does not seem to be very well realised in the concrete world. There seem to be no end of booms, busts, changes, political innovations, technological innovations, changes in overall economic parameters such as relationships with international trade, international corporations, international financial parameters such as exchange rates and interest rates, all seem to be militated against the assumption of equilibrium. This has led many to be more focused on the fluctuations which seem common in the community, both socially and in economics. The nature of these fluctuations is itself quite baffling. The study of fluctuations is usually reduced to the assumption that economic and social change follows some sort of recurring cyclical patterns, and so there has been considerable interest in the reduction of these aspects of human behaviour to various types of cycles. Despite the convenience of conceptualising economic fluctuations as recurrent cycles, we've found great difficulty fitting them into the mathematical constraints that a physicist or a scientist would see as genuinely cyclic. However, there are some general trends that we can observe. Economic cycles or fluctuations have been observed for some time, and a number of theorists have given their names to the different lengths of cycles, the different cycle periods that seem to emerge. The shortest cycles tend to be seasonal and fairly simply related to summer or winter, perhaps monthly or even weekly cycles that are aligned to changes in economic activity due to the weather or the day of the week and the fact of weekends. However, most property people are of the opinion that property fluctuates according to an 8 to 10 year cycle. This cycle is known as the kitchen cycle, and it has the advantage of being frequent enough for most people to have experience of several cycles within living memory. However, a stronger pattern of cyclical behaviour tends to operate with a period of about twice the kitchen cycle, that is, about 16 to 20 years. This 16 to 20 year cycle is known as the Kuznets cycle, after the theorist who first presented it, and there seems to be significant evidence that the Kuznets cycle does in some way exist. To experience a number of Kuznets cycles, one needs to be fairly old, and so personal understanding from experience is fairly rare. Behind the Kuznets cycle, there is even a longer cycle known as the Kondratiev cycle, again after the first theorist who observed it. The Kondratiev cycle has a period of about 50 years. The curious thing about the Kondratiev cycle is that it extends right the way back to the dawn of modernity, with the first Kondratiev cycle occurring around 1530. After that date, there has been a major depression very close to every 50 years ever since. That is, with the exception of the last 80 years. During the 1970s and the 1980s, there was considerable interest in the Kondratiev cycle because at that time we were coming up for a due major economic depression, being 50 years after the Great Depression of 1930. However, that depression didn't seem to occur, or at least it didn't occur on time, which would have put it around 1970 to 1990. A number of people considered that the depressions that occurred in the late 1980s, such as the 1986 recession in the United States or the 1989 boom and bust in Australia, were in fact the Kondratiev cycle that had been a little bit delayed. However, more insightful observers considered that the 1990 depression or recession was only the foreshock for a more significant correction that would have been likely to happen somewhere like a decade or two in the future. The year 2004 had been predicted for the next Kondratiev cycle from about 1990 onwards. This means that the GFC is very much a Kondratiev cycle, although we do have the question of how to explain why it's about 30 years late. For all three cycles, there is not only an economic explanation or description, but there is also a more general explanation couched in the complexities of human psychology and society. This can be seen most clearly with the Kondratiev cycle. Long-wave theorists, who are those people who study the Kondratiev cycle, have noticed that there are a number of social phenomena that also seem to follow the 50-year long wave that Kondratiev discovered. These include the popularity of wars, the importance or the militancy associated with feminist issues, and even things like animal rights movements. Other theorists have gone as far as to suggest that sunspots seem to have an influence, or can have an influence, on the cyclical behaviour of the economy. However, this theory, while it actually conforms fairly closely to the data, has been put aside because we no longer live in an agricultural economy. While putting aside sunspots as the cause of business cycles might seem reasonable at this point in time, to turn one's back on the psychological motives behind human behaviour would be rather foolhardy. And there does seem to be good cause to consider that business cycles are in fact a manifestation of changing attitudes in human society. The 50-year Kondratiev cycle can be explained as being roughly 2 generations, and it is considered that if, say, a generation is made up of persons who grew up during depressed conditions, those people are likely to be very diligent and hard-working. Under those conditions, such a community would have a workforce that is likely to be highly productive and lead to economic bounty. However, their children would be likely to be brought up seeing parents who work very hard and living in a fairly affluent society. Those children, it is suggested, would look at their parents rather askance and consider that they work too hard, and therefore they'd be more likely to take things easy. When those children become the workforce, their work ethic is hardly likely to support a productive economy, and their lassitude would be likely to lead ultimately to a depression, and so the cycle begins. In this way, the 2-generation theory that lies behind the Kondratiev cycle does have a certain amount of human merit. To some extent, our preoccupation with naming generations and their peculiarities in recent times would seem to fit into the overall background behind the Kondratiev cycle. We can only surmise what effect the baby boomers had on causing the GFC, and there are more than a few people who will be willing to go to print saying that the effect is more than chance. While the Kondratiev wave can be seen in terms of the long-term effects of generational change, we can see that the human decisions on shorter terms also follow similar patterns of human affectation or psychological disposition. We even see that in the way that we describe economic behaviours, where we talk about the psychology of the market, its optimism or pessimism, and so on. Overall, what we can say is that business cycles are the result of human decisions, their feelings, their fears, and to a certain extent their culture. In particular, we see that cycles are in fact a product of modernity. They do not seem to have been apparent in non-modern cultures. If we look at purchasers as emotional creatures, we can then produce a cycle from optimism to pessimism and depression that will infer market activity that will either be expansionary or cause contractions. And this is a fairly well-established background or backdrop to economic cycles. From this emotional foundation, we find the hard activities of buying and selling reflected in the marketplace. And this is usually depicted as a smooth cycle model pretty much on the sine curve from physics and mathematics. In real estate, we talk about the property clock, as though attitudes of optimism and pessimism in the market swing smoothly around in a circular pattern from one to the other. However, while fluctuations are certainly real, the nature and shape of the fluctuations hardly smooth. Real fluctuations tend to have cusps or points rather than smooth turning points. There are breaking of expectations, radical changes of expectations of gain, and so on. A property boom is usually characterized by almost unbridled optimism that the boom will continue forever. However, when reality strikes, it's not a smooth turning point, but rather a sharp crash that occurs. The escape from the pessimism of correction tends to be not quite as jagged, but likewise it's not a smooth transition. These cusps, breaks, and major turning points tend to suggest a complex causality. That is, that there's more than one factor at play. And in particular, we find that the calculus that any particular individual makes when approaching the market is based on all of their life's experiences. These include recent history, but also the long-term expectations in history, and maybe beliefs that they have inherited or been taught from previous generations. This means to fully understand the psychology of economic cycles, it is necessary to have a fairly strong understanding of the way that the decision makers today are influenced by the effects or the history of yesterday, and also the players of yesterday. When we move to property cycles, we find they are indeed a special case of business cycles, because property cycles, one way or another, stand on the back of the overall economy, because the rent, after all, that is charged, whether it be to an individual or a business, is very much dependent on that individual or business making sufficient income from using the property to be able to pay the rent. And so we consider property cycles to be merely a special part of the business cycle. Likewise, property cycles are usually modelled and presented as smooth sine curves derived from physics. And along with that assumption of the sine curve are the assumptions of regularity, both in terms of wavelength and amplitude. While it's appealing to be able to conceptualise property cycles as having such regularity, we do not find it evident in the data. And in fact, predicting property cycles has proven to be extremely difficult and has been the cause of many lost fortunes. If we move to looking at what causes the property cycle, we find that the patterns of causality for real estate is really quite complex. This diagram of the property cycle may appear to be complicated, but in fact it is intended to be a simplification of the various processes that influence the demand for space, rents, and prices. When we look closely at it, we find that it is not one cycle, but several. There is at least a property cycle and a construction cycle, which is normally associated with real estate. But both of those nest within the financial cycle of interest rates, but also the general economic cycle, which is associated with production. And all of these have their own patterns of causality. I invite the students to go through this diagram carefully and to look at the ways that each section in the diagram tends to lead on to instability, leading on to change in the next item, going around the cycle. What it means is that the property cycle is in fact a very complex pattern of interrelated causality. By this we mean that there's no one simple cause for the property cycle, but rather a series of factors operating in a very non-linear way at various times in the cycle. One way or another, they are based on individual players in various parts of the cycle trying to take advantage, what is known in economics as rent-taking. And that attempt by the various players in the property network To take rents at the expectation of the future necessarily creates an intrinsic instability. And while this instability is only applied locally, the overall effect of it is a global pattern of property instability, which evidences itself as the periodic fluctuations. We need to be a little careful using the expression periodic, because that expression infers that in some way the cycles or the fluctuations do recur with some sort of precise timing. They don't. While they tend to operate more or less between 6 and 10 years for the kitchen cycle, we can't say that 8 years from the last depression or recession is going to be exactly the time when the next one will occur. And the errors in timing themselves can be the make or break of great fortunes. This is why it's better to talk of fluctuations rather than cycles, because the notion of fluctuations tends to infer a bounded uncertainty as to the result, with some vague pattern, but certainly not the regularity that the expression cycle correctly infers.